Picture this. You spend 14 days hosting business meetings in your home and you legally pocket $7,000 completely tax-free, no taxes withheld, no reporting as income, nothing. This is not some offshore scheme or crypto loophole. This is Section 280A, AG of the Internal Revenue Code, also known as the Augusta Rule, and 90% of business owners have never heard of it. And here's what really blows my mind. The average American overpays their taxes by $800 to $1,200 every single year simply because they do not know these rules exist. That is not a guess. That is data from tax preparers across the country. Today, I am going to walk you through 15 forgotten tax laws that could save you thousands in 2025. These are not sketchy loopholes. These are IRS-approved strategies written into the tax code that your CPA might not even tell you about because they assume you do not qualify. Look, I get it. Tax season feels overwhelming. You file your return. You either get a small refund or you owe money and you move on with your life. But what if I told you that buried in the 75,000 pages of the US tax code are legal deductions and credits that most people never claim because they simply do not know they exist? That ends today. By the end of this video, you are going to know exactly which deductions you qualify for, how much they are worth, and what documentation you need to claim them. And yes, everything I am about to share is 100% legal and backed by official IRS publications. Let us start with number 1, the Augusta Rule. This is hands down one of the most powerful tax strategies most business owners have never heard of. Here is how it works. Section 280, AG of the Internal Revenue Code allows you to rent your home to your business for up to 14 days per year, and that rental income is completely tax-free. Meanwhile, your business deducts the full rental expense, so if you charge a reasonable market rate of $500 per day for 14 days, that is $7,000 of tax-free income to you personally, while your business saves on taxes from the $7,000 deduction. But here is the catch. You must have a legitimate business purpose. Board meetings, strategic planning sessions, client meetings, these all count. You need a written rental agreement, meeting minutes, documentation of reasonable market rent in your area, and actual payment from your business to you. This works for C Corps and S Corps. If you are a sole proprietor, unfortunately, this does not apply to you because you cannot rent to yourself. Number 2, Section 179, expensing. For 2025 tax years, you can expense up to $2,500,000 of qualifying business property. Let me say that again, $2.5 million. This is up from prior limits, and the phase-out threshold has been raised to $4 million. This means instant write-offs instead of depreciation over years. Most business owners know about this for equipment and vehicles, but here is what they forget. Off-the-shelf computer software qualifies. Certain HVAC systems qualify. Fire and security systems qualify. And roofs for non-residential property qualify. You just bought a commercial building and put on a new roof? That could be a Section 179 deduction instead of depreciating it over 39 years. Number 3, the qualified business income deduction just got better. Starting in 2026, not 2025, but 2026, Section 199A now includes a $400 minimum deduction for taxpayers with at least $1,000 of qualified business income from a trade or business in which they materially participate. This change became permanent under the One Big Beautiful Bill Act, signed July 4, 2025. The standard 20% deduction remains, but this minimum ensures even small business owners benefit. So if you are a freelancer, consultant, or side hustler making at least $1,000, mark your calendar for 2026 because you just got a guaranteed $400 deduction. Number 4, the home office deduction simplified method. This is massive for remote workers, and you do not need to be self-employed to claim it if you use your home office for the convenience of your employer. The simplified method allows $5 per square foot up to 300 square feet. That is a maximum $1,500 deduction with zero depreciation recapture concerns. Many taxpayers avoid the home office deduction thinking it is an audit red flag. That is a myth. The simplified method is straightforward. Measure your dedicated workspace, multiply by $5, claim the deduction, and here is the kicker. You can still claim your full mortgage interest and property taxes on Schedule A. You are not giving anything up. Number 5, Earned Income Tax Credit. This is the big one. The EITC is claimed by only about 80% of eligible taxpayers, leaving billions, with a B, unclaimed annually. For 2026, the IRS just released updated numbers. With 3 or more children, married couples filing jointly can get up to $8,231. With 2 children, $7,316. With 1 child, $4,427. Even with no children, you can get up to $694 if your income is low enough. The income limits for 2026 are generous, up to $66,819 for married couples filing jointly with 3 or more children. Even moderate income taxpayers may qualify, especially if you had a lower income year due to job loss or business downturn. Number 6, Child and Dependent Care Credit. This can provide significant savings for working parents. This covers not just daycare, but also summer day camps, not overnight camps, before and after school programs, and even babysitters while you work. Many parents do not realize summer camps qualify. That is money you are already spending that could reduce your tax bill. Number 7, the Retirement Savings Contributions Credit, also known as the Savers Credit. This gives low to moderate income taxpayers up to $1,000, $2,000 if married filing jointly, simply for contributing to retirement accounts. For 2024, single filers with income up to $38,250 qualify. Married filing jointly, up to $76,500. And here is the beautiful part. This is a credit on top of the tax deduction you already get for IRA or 401k contributions. So you get the deduction, which lowers your taxable income, and you get the credit, which directly reduces your tax owed. That is a double benefit most people miss. Number 8, Work Opportunity Tax Credit. Small businesses, listen up. This provides 25 to 40% of qualified wages up to $1,200 to $9,600 per employee for hiring from target groups including veterans, ex-felons, SNAP or TANF recipients, and vocational rehabilitation referrals. Employers collectively receive over $1 billion annually through the Work Opportunity Tax Credit, yet many small businesses never apply. You have to apply before or shortly after hiring the employee, but the credit can be substantial. If you run a small business and you are hiring, talk to your CPA about this before you make your next hire. Number 9, State Sales Tax Deduction. If you live in a state with no income tax like Texas, Florida, or Washington, or if you had major purchases like a vehicle, boat, or home renovation materials, you can deduct state sales taxes instead of state income taxes as part of your SALT deduction up to $10,000 total. The IRS provides tables, or you can track actual receipts for larger savings. If you bought a car this year, that sales tax alone could be thousands of dollars. Most people just default to income tax without realizing they have a choice. Run both calculations and pick the higher deduction. Number 10, Reinvested Dividends. This is a massive one that people miss, and it costs them hundreds or even thousands in overpaid capital gains taxes. When you automatically reinvest dividends in mutual funds or stocks, each reinvestment increases your cost basis. Many taxpayers forget to add these to their basis when selling, resulting in overpaid capital gains taxes. If you have held a fund for 20 years with dividend reinvestment, this could be thousands of dollars in cost basis you are forgetting to claim. Pull your statements, add up every reinvested dividend. That is money you already paid taxes on, and you should not pay taxes on it again when you sell. Number 11, tax preparation fees from the prior year are deductible in the current year. If you paid $400 to have your 2023 taxes prepared in 2024, you can deduct that $400 on your 2024 return. This applies whether you used a CPA, enrolled agent, or online service like TurboTax. Number 12, state tax paid with prior year return. If you owed state taxes when filing your 2023 return in April 2024, that payment is deductible on your 2024 federal return, subject to the $10,000 SALT cap. Many taxpayers forget to include this spring payment along with their withholding. That could be hundreds of dollars you are leaving on the table. Number 13, Research and Development Tax Credit. This is one of the most underclaimed credits because businesses think they do not qualify. But here is the thing. The definition of research is way broader than most people realize. Developing new products counts. Improving processes counts. Creating software counts. Enhancing existing products counts. Even failed experiments count. Eligible businesses can claim 6 to 10% of qualified research expenses. If you spent $50,000 on developing a new product or improving your manufacturing process, that could be $3,000 to $5,000 back in your pocket. Most small businesses never even ask their CPA about this because they assume it is only for big tech companies. It is not. Number 14, Disabled Access Tax Credit. This provides 50% of qualified expenses up to $10,250 for a maximum $5,000 credit for small businesses with under 30 full-time employees and under $1 million in revenue. This covers costs to make your business ADA compliant. Ramps, accessible restrooms, sign language interpreters, accessible parking. Number 15, Retirement Plan Startup Credit has been enhanced. Small businesses with fewer than 100 employees can now claim 50 to 100% of startup costs up to $5,000 for establishing a 401k, simple IRA, or SEP plan. Plus, there is a new employer contribution tax credit that started in 2023 that can provide additional savings when you contribute to employees' accounts. Okay, let us do a reality check here. If you are watching this and thinking, wow, I had no idea about any of these, you are not alone. The tax code is deliberately complex, and even good CPAs sometimes miss these because they are not specifically asked about them or because they assume you do not qualify without digging deeper. So let me give you the 5 biggest takeaways before we wrap up. Number 1, the Augusta Rule. 14 days of tax-free rental income if you have a C Corp or S Corp. $7,000 is just sitting there. Number 2, Section 179, $2.5 million expensing limit for 2025. Think beyond vehicles, software, HVAC, security, roofs. Number 3, earned income tax credit. Updated amounts for 2026, up to $8,231 with 3 or more kids. Even no kids gets you $694. Check if you qualify. Number 4, home office deduction, $5 per square foot. Simplified method, up to $1,500. No depreciation recapture. Stop being afraid of this. And number 5, Savers Credit, double benefit, deduction plus credit for retirement contributions, up to $2,000 if married filing jointly and your income is under $76,500. Look, here is the bottom line. Documentation is everything. The IRS does not accept, trust me. You need contemporaneous records. For the Augusta Rule, you need a written rental agreement, board meeting minutes, reasonable market rent documentation, and payment records. For home office, take photos and measurements. For business expenses, keep receipts and mileage logs. Timing matters. Many of these strategies require action before year-end. Section 179 expensing requires the property be placed in service by December 31st. Retirement contributions except IRAs must be made by December 31st. The Augusta Rule rental days must actually occur during the tax year. And here is my biggest piece of advice. Professional guidance pays for itself. Tax preparation fees averaged $400 to $600 for individuals, but can save thousands through proper planning. A qualified CPA or enrolled agent who specializes in small business taxation will know these strategies and dozens more specific to your situation. Also remember, state rules vary. While these are federal tax laws, state treatment may differ. Some states do not conform to federal Section 179 limits, for example. Always check your state's rules or consult a tax professional familiar with your state. All right, if you found this helpful, I need you to do me 3 quick favors. Number 1, smash that subscribe button. We drop videos every week breaking down complex tax strategies into simple, actionable advice, and I promise, no boring lecture-style content. Just real-world strategies that actually save you money. Number 2, share this video with someone who needs it. Your friend who just started a business, your family member who works from home, your colleague who is always complaining about their tax bill. Knowledge is power, but only if you use it. And you would be amazed how many people are overpaying simply because they do not know these rules exist. And number 3, drop a comment below. Tell me which of these 15 strategies you are going to use this year. Are you going to try the Augusta Rule? Are you a small business owner who is going to look into the R&D credit? Are you going to finally claim that home office deduction? I read every single comment and I will answer your questions. And if you have a specific tax question, leave it in the comments. I cannot give personalized tax advice in the comments, but I can point you in the right direction or maybe even make a video answering your question if it is something a lot of people are asking about. Also, quick reminder, this is educational content, not personalized tax advice. Tax laws change frequently, so always verify current year rules with official IRS sources at irs.gov and consult a qualified CPA, enrolled agent, or tax attorney for your specific situation before implementing any tax strategy. Keep detailed records for all deductions and credits claimed. The IRS is not playing around, and neither should you when it comes to documentation. Thank you so much for watching. Seriously, the fact that you made it all the way to the end tells me you are serious about keeping more of your hard-earned money. Remember, the average American overpays by $800 to $1,200 every year. Do not be average. Use these strategies, talk to your CPA, and take control of your tax situation. I will see you in the next video where we are going to break down even more tax strategies that nobody is talking about. Until then, stay smart, stay legal, and keep more of what you earn. Peace!